Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Commercial Property Development Finance Guide. Commercial property development finance is a crucial aspect to consider when embarking on a project. This type of finance, which can include various funding options, caters to developers looking to acquire, refurbish, or build commercial properties. Understanding the ins and outs of development finance will set the foundation for a successful property venture, and ensure that you are well prepared to manage the financial aspects of your project. Understanding development finance. When it comes to commercial property development, understanding the different types of finance options available to you is essential. Development finance is a type of business finance used to fund residential, commercial, or mixed-use property developments. It can include term loans, mortgages, bridging loans, and even personal loans. As a developer, you will typically borrow money from a lender to finance the acquisition of land and the subsequent property development. After the building is completed, the property can be sold or used as an income source for investment purposes. The funds provided by development finance will help manage your cash flow throughout the construction phase, ultimately impacting the profitability of your development project. The costs of development finance for commercial property can vary depending on the nature of the project. For properties occupied by the developer's business post-completion, rates can start at 3.5% per annum. However, for traditional developments designed for selling or letting, realistic rates range between 7 to 11.4% per annum. There are several options available when it comes to property finance. These options can impact the availability of cash, support your initial investment, and shape the development project's financial outcome. It's important to explore your finance options early in the process, ensuring that you choose the most suitable and cost-effective solution for your specific needs. Equity. As a developer, you may choose to use your own cash or seek investment from partners or third parties. By using equity to finance developments, you can demonstrate commitment to the project and gain leverage when borrowing additional funds. Loan. A loan, in the form of a term loan or mortgage, is a popular choice for financing developments. This method of borrowing allows you to repay the loan over a specified period, with interest. The loan terms and interest rates will vary based on factors such as the development size, location, and risk profile. Bridge loan. Bridging loans are short-term, high-interest finance options designed to bridge the gap between the purchase of a property and the longer-term funding arrangement that will follow. These loans can be particularly useful for commercial property developers who require fast access to funds, usually for property acquisitions or refurbishments. By understanding development finance and the various finance options available to you, you can make informed decisions about the best way to fund your commercial property development project. The right choice of finance can not only help ensure a successful project but also contribute to the long-term growth and success of your property portfolio. Types of commercial properties. When considering commercial property development finance, it's essential to understand the various types of commercial properties available. These properties serve different purposes and require specific financial arrangements. In this section, we'll explore some of the main categories of commercial properties in the UK, so you can better understand your options. Firstly, office blocks are a common type of commercial property. These buildings are designed to house businesses and provide workspaces for employees. As a developer, you may consider constructing new office blocks or refurbishing existing ones. Keep in mind that office spaces can vary in size, ranging from small units to larger, multi-story complexes. Another popular commercial property is retail spaces. These properties cater to businesses that sell products or services directly to consumers. Retail spaces can include shopping centers, high street shops, and supermarkets. When developing retail properties, consider factors such as location, foot traffic, and nearby competition to ensure your project's success. Industrial units also fall under commercial properties, serving as spaces for manufacturing, assembly, or warehousing. These properties often require specific building features and infrastructure to accommodate the machinery, storage facilities, and logistics involved in industrial operations. As a developer, you should be aware of the specific needs and regulations associated with industrial property development. Student housing. Developments cater to the needs of university students, providing accommodation tailored to their requirements. Developing student housing can involve constructing new purpose-built flats, or converting existing properties into suitable living spaces. When planning a student housing project, consider factors such as proximity to university campuses, public transport, and local amenities. In summary, commercial properties encompass a diverse range of developments, including office blocks, retail spaces, industrial units, and student housing. By understanding the specific characteristics and requirements of each property type, you can make informed decisions when seeking commercial property development finance. Remember to keep your project's individual needs and market demands in mind, ensuring a successful and profitable development. Commercial property development. When embarking on a commercial property development project, it's crucial to understand the various financing options available to you. Commercial property development finance is designed to help developers or business owners fund the construction or renovation of commercial properties. These properties can then be let, sold, or used as a base for the developer's own business. One financing option to consider is commercial mortgages, which can be tailored to accommodate various property types, including offices, retail spaces, and industrial units. Commercial mortgages are designed with flexible terms and repayment structures, making them suitable for a wide range of real estate development projects. When navigating the commercial property market, it's essential to have a clear understanding of the different types of commercial property finance available. Property development finance encompasses a variety of finance options, such as term loans, bridging loans, and, as previously mentioned, commercial mortgages. 2. By choosing the most suitable financing option for your project, you can ensure a smooth process and improve overall profitability. In addition to funding the initial investment, commercial property development finance can also support cash flow throughout the construction phase. It is typically issued on a stage release basis, thus offering access to capital in line with the project's progression. 3. This short-term finance solution can significantly impact the availability of cash, assisting developers during the most critical stages of their projects. Ultimately, securing the right type of property development finance is vital for the success of your commercial property development project. By familiarizing yourself with the various financing options and understanding the nuances of the commercial property market, you can make informed decisions and enhance the overall potential of your development. Lenders and mortgages. When considering commercial property development finance, it's essential to explore different lenders and mortgage options. In this sector, you'll find a variety of financial institutions willing to offer commercial mortgages, including high street banks, specialist lenders, and private funding sources. High street banks are often the first option for property developers seeking finance. They provide competitive interest rates and terms for well-established businesses. However, they may have stricter lending criteria, making it difficult for smaller or less experienced developers to secure funding. On the other hand, specialist lenders cater specifically to the property development market, offering tailored mortgage solutions to meet developers' unique requirements. These lenders typically have a deeper understanding of the challenges faced by property developers, and might be more flexible in terms of loan criteria and repayment options. In addition to mortgages, commercial property developers might also consider alternative forms of finance, such as bridging loans or short-term funding options. These can be useful for developers seeking funding quickly or those facing various complexities during the development process. When exploring lenders and mortgages, it's crucial to assess the loan-to-value (LTV) ratio, interest rates, loan terms, and any fees associated with the loan. Comparing different mortgage options will allow you to find the best fit for your specific project and financial needs. Remember to thoroughly research and review potential lenders before committing to a mortgage. Take your time, gather all the necessary documentation, and ensure you fully understand the terms and conditions of your chosen loan. By being well prepared and maintaining a clear and confident approach, you're more likely to secure the finance needed for your commercial property development project. Understanding buy-to-let mortgages. When you're looking to invest in commercial property, buy-to-let mortgages can be a valuable financial tool. In this section, we will explore the basics of buy-to-let mortgages and how they relate to commercial property development. Buy-to-let mortgages are specific types of commercial mortgages designed for individuals or businesses looking to purchase property with the intention of renting it out to tenants. These mortgages differ from residential mortgages, as they cater to the unique requirements of commercial property investment and often come with different terms and conditions. One aspect of buy-to-let mortgages that sets them apart from residential mortgages is the calculation of affordability. Lenders typically use the rental income generated by the property to determine if you can afford the mortgage repayments. This is known as the rental coverage or interest cover ratio, ICR, which is often expressed as a percentage. Generally, lenders require an ICR of 125% or more, meaning the rental income should be at least 125% of the mortgage interest payments. Additionally, commercial buy-to-let mortgages often come with higher interest rates and fees compared to residential mortgages. This is due to the perceived higher risk involved in commercial property investments. To secure the best deal on your buy-to-let mortgage, it's crucial to shop around and compare various lenders' terms and conditions. Do keep in mind that commercial buy-to-let mortgages are usually offered to limited companies, rather than individuals, for investing in commercial property types such as offices, retail, industrial, or healthcare spaces. However, the qualification criteria may vary from lender to lender. Lastly, when you apply for a buy-to-let mortgage, be prepared to provide evidence of your income, credit history, and details about the property you intend to purchase. This will help the lender assess your application more accurately, and potentially offer you a competitive mortgage product tailored to your specific needs. With these points in mind, you can confidently navigate the world of buy-to-let mortgages to find the right financial solution for your commercial property investment journey. Short-term property finance. When venturing into commercial property development, you may require short-term funding solutions to kickstart or progress your project. This is where short-term property finance options like bridging loans come in handy. Bridging finance can provide you with quick access to funds, allowing you to purchase a property or start the development process without any delays. It is designed for situations where a traditional mortgage may not be available or suitable. A key benefit of bridging loans is their flexibility and speed, as they can often be agreed upon and distributed in a matter of days. In addition to bridging loans, there are other short-term funding options available. For instance, a commercial mortgage might be a suitable choice if you plan on developing the property for your own business use or for leasing. Commercial mortgages can have flexible repayment terms and competitive interest rates, making them an attractive option for some developers. The choice between bridging finance, commercial mortgages, and other short-term funding options will depend on your specific circumstances and the nature of your project. To make the best decision, carefully consider factors such as your cash flow, project timeline, and expected future income. It is crucial to work with a knowledgeable and experienced finance broker or lender who can guide you through the process of securing short-term property finance. They can assist you in finding the most suitable funding option tailored to your specific needs and goals. By understanding and utilizing short-term property finance solutions, like bridging loans, you can ensure your commercial property development project runs smoothly and efficiently. Transactions and legal aspects. When dealing with commercial property development finance, it is essential to understand the various transactions and legal aspects involved. This guide will provide you with a brief overview of these topics, focusing on transactions, solicitors, planning permissions, and paperwork. To begin with, the financing process for a commercial property development typically involves a series of transactions. These transactions may include securing loans or grants, negotiating with contractors and suppliers, and managing payments throughout the development process. It's crucial to have a clear understanding of the different transactions involved, as they can impact the success of your development project. Solicitors play a vital role in the commercial property development finance process. They help you navigate the complex legal landscape, ensuring that all parties involved in the transactions follow the relevant laws and regulations. This includes drafting and reviewing contracts, negotiating terms with lenders, and providing advice on any legal issues that may arise during the project. Planning permissions are another critical aspect of the commercial property development process. Before starting any construction or development work, you must obtain the necessary planning permissions from local authorities. This ensures that your project complies with the relevant zoning regulations, building codes, and environmental standards. It is essential to work closely with your solicitor and planning consultants to ensure you obtain the necessary permissions for your project. Paperwork is a significant part of any commercial property development finance transaction. It includes everything from loan agreements to planning permission documents, contracts with contractors and suppliers, and any other legal or financial documentation required for the project. Therefore, it's crucial to stay organized and have a system in place to manage the paperwork. This will make it easier for you to track and access important documents when needed. In conclusion, understanding the transactions and legal aspects of commercial property development finance is critical for the success of your project. By familiarizing yourself with these elements, you can make informed decisions and ensure that your project stays on track and complies with all relevant regulations. Remember to consult with solicitors and planning consultants to help navigate the legal landscape and obtain the necessary permissions for your development. Understanding valuation and fees. When embarking on a commercial property development project, it is essential to understand the various fees and valuation methods involved in acquiring development finance. This will enable you to plan your finances effectively and ensure the project runs smoothly. One of the key components to consider is the valuation fee. This fee is generally paid to a professional valuer who determines the market value of the property and its future potential. The valuation is crucial for lenders, as it helps them assess the risks associated with the investment and decide on the loan amount. Another important fee to be aware of is the arrangement fee. This fee is charged by the lender for setting up and managing the development loan. Arrangement fees can vary, but are typically calculated as a percentage of the loan amount. It is essential to factor this cost into your budget when seeking development finance. Professional fees are also an integral part of the development process. These fees are payable to various experts, such as architects, engineers, and solicitors, who provide specialist services throughout the project. Such fees can have a significant impact on the overall costs, and thus it is vital to account for them when planning your finances. A broker fee may also apply if you engage the services of a broker to assist in securing development finance. Brokers can provide valuable support and advice, but their fees can be an additional cost to consider. It's essential to weigh the benefits of using a broker against the cost of their services. Lastly, it is crucial to understand the concept of gross development value, GDV. This term refers to the estimated market value of a development project once it is completed and fully operational. Lenders use the GDV to determine the potential profits and gauge the maximum loan amount they are willing to provide. In conclusion, being equipped with the knowledge of valuation methods and various fees associated with commercial property development finance allows you to create a well-informed financial plan and navigate through the complexities of the development process with confidence. Schedule and construction. When planning your commercial property development, you must create a detailed development schedule and carefully manage the construction phase to ensure success. The schedule should outline every aspect of the development, from acquiring permits to hiring contractors and completing the building's fit-out. To create an efficient development schedule, consider the following steps. Obtain planning permission. Before the construction process can begin, you need to secure planning permission for your commercial development. This may involve submitting architectural plans, site surveys, and other necessary documentation. Hire a professional team. Assemble a team of experienced professionals, including architects, engineers, and contractors, to help manage the different aspects of your project. Having a skilled team on board will help ensure that your vision becomes a reality. Create a construction timeline. Develop a timeline for the construction phase, outlining each stage of the process and setting realistic deadlines for completion. This should include site preparation, foundation work, building erection, and fit-out stages. Secure funding. You'll need adequate commercial property development finance to fund your project. Getting started with the right financial product is crucial for a smooth development process. Monitor progress. During the construction phase, it's essential to regularly review the project's progress, ensuring that the timeline stays on track and quality standards are met. Address any problems or delays as quickly as possible and maintain communication with your team. By carefully planning your schedule and managing the construction phase, you can mitigate risks and ensure the smooth completion of your commercial property development. Remember to keep your team informed, stay on top of deadlines, and adjust your plans as necessary to achieve a successful outcome. Profit and returns. When venturing into commercial property development, profits and returns are crucial indicators for your investment success. Understanding these aspects helps you make informed decisions about what projects to pursue and how to maximize your gains. As a developer, your profit is the difference between the total project cost and the sales revenue generated after your development is complete. To achieve attractive profit margins, it's essential to implement strategic decisions such as efficient constructions, attractive designs, and competitive pricing. Be diligent in estimating costs, monitoring market trends, and avoiding delays, which can adversely impact your project's profitability. Evaluating the profitability of your development is vital in determining the attractiveness of investment opportunities. Conducting feasibility studies is necessary to understand the potential returns, and establish key performance indicators like return on investment, ROI, and return on equity, ROE. Utilizing these metrics enables you to compare the potential rewards of different projects and prioritize high-performing ones. Yield is a financial metric that measures how much income your commercial property investment generates compared to the initial cost. In the context of commercial property development, this usually refers to the rental income earned from leasing the property to clients. A high yield indicates a strong rental income relative to your investment and is usually associated with successful commercial developments, to enhance your portfolio's profitability and returns. Carefully select the location for your development. Optimize your development's design for functionality and aesthetics. Manage project costs to prevent budget overruns. Maintain a strong relationship with tenants. In summary, understanding and monitoring the metrics involved in profit, profitability, and yield are paramount in commercial property development. Focusing on these factors can ensure your ventures deliver favorable returns and contribute to your overall investment goals. Loan repayments. When it comes to repaying your commercial property development finance, it's important to have a clear understanding of the repayment terms and options available to you. In most cases, development loans are tailored to suit your project's unique needs, meaning the repayment structure will be flexible and based on your development's progress. One essential aspect to consider is the drawdown facility. Drawdowns allow you to access funds in stages instead of as a lump sum. This can help you manage your cash flow better during the development process. Lenders typically release funds as your project reaches specific milestones, such as completing groundwork or constructing the roof. This ensures that the loan amount is used appropriately and reduces the risk for the lender. A grace period may be offered by some lenders, giving you breathing room before repayments begin. This can be particularly beneficial for property developers, as it allows time for construction to start generating income before repayments need to be made. Keep in mind that not all lenders will offer a grace period, so make sure to inquire about this when discussing loan terms. Commercial development loans usually include the loan-to-cost (LTC) ratio, which indicates the proportion of the total cost that is covered by the loan. The higher the LTC, the more generous the loan is in terms of funding. Many lenders offer up to 75 to 80% of the total cost involved, although, on occasion, some may even provide up to 100% of the total build cost if the loan's value is lower than 60% of the gross development value (GDV) source. Refinancing can be another viable option for repaying a commercial property development loan. This process essentially means replacing your existing loan with a new one, adhering to new terms, and potentially securing a more favorable interest rate. It can be an advantageous strategy if you find a more competitive finance option, or require additional time to complete your project or sell the developed units. When your development project begins generating revenue, repaying the loan usually involves the sale of units or properties within the development or, alternatively, converting the loan to a long-term commercial mortgage. Make sure to discuss your repayment options with your lender or a financial advisor, to ensure you understand the best strategy tailored to your circumstances. Final thoughts on commercial property development finance. When entering the realm of commercial property development, having a comprehensive understanding of the available finance options is essential for your success. As you embark on this journey, it's crucial to explore different commercial property development finance options to determine which one best suits your specific project. In the world of property development finance, various loan products can cater to your needs depending on the project's scope. Some of the options you may come across include term loans, bridging loans, and commercial mortgages. It is essential to assess each option's benefits and drawbacks to make an informed decision. As you navigate the finance landscape, remember the importance of securing the right type of funding for your project. This could include options like converting existing properties, developing land into housing, or even renovating multiple occupation houses, HMOs. Source: choose a finance solution that aligns with your operational and financial goals. Moreover, do not underestimate the significance of finding a lender that understands your specific requirements and industry nuances. By working with a specialized lender, you can streamline the funding process and increase your chances of success. To sum it up, commercial property development finance plays a pivotal role in ensuring your project can thrive. Don't shy away from seeking expert advice and conducting thorough research to make the most informed decisions. By selecting the appropriate financing and embracing a strategic approach, you can enhance your commercial property development project's viability, cash flow, and eventual profitability. What are the best financing options for property development? There are several financing options for property development, each with its own benefits and drawbacks. These include development finance, term loans, bridging loans, and commercial mortgages. The best option for your project will depend on factors such as the scale of the development, your financial situation, and your experience as a developer. How can a first-time developer secure finance? As a first-time developer, securing finance can be challenging due to a lack of experience and track record. However, there are steps you can take to improve your chances. Start by developing a solid business plan, showcasing your project's feasibility, projected revenues, and your team's expertise. You should also be prepared to invest some of your own capital into the project, as most lenders require a level of skin in the game. Finally, consider partnering with experienced developers or contractors who can vouch for your skills and experience. What are the criteria for obtaining development project funding? Lenders usually consider the following criteria when evaluating a development project for funding: the experience and track record of the developer, the financial strength of the developer or development team, the viability and profitability of the project, the location and market demand for the finished development, the amount of developer's own capital invested in the project, the quality of the project's collateral and security offered. How do property development investors evaluate projects? Investors typically evaluate property development projects by examining various factors like expected returns, project feasibility, developer experience, and market conditions. In addition, they analyze factors such as project timeline, location, planning permissions, projected sale or rental prices, and overall market demand. Finally, they'll assess the exit strategy to ensure a viable return on their investment. What role does a real estate development fund play? A real estate development fund is a pool of capital from multiple investors used to finance real estate development projects. These funds provide an alternative financing option for developers seeking to raise capital for their projects. In return for their investment, fund investors typically receive a share of the project's profits, either through a regular income stream, capital appreciation upon the sale of the property, or a combination of both. How do you calculate the cost of development finance? The cost of development finance depends on various factors such as the loan amount, interest rate, loan-to-value (LTV) ratio, and loan term. Rates for commercial property development finance can start as low as 3.5% per annum for properties occupied by the developer's business post-completion, and 7 to 11.4% per annum for traditional developments built to sell or let. To calculate the total cost of finance, you'll need to factor in interest payments, arrangement fees, and any other associated costs, such as valuation and legal fees. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.